Thanks everyone for joining the Center for Financial Security at the University of Wisconsin-Madison and the Wisconsin Department of Employee Trust Funds today for our targeted research workshop on forgotten savings, exploring the issue of unclaimed retirement accounts. Just to give everyone a bit of a rundown of our program today, we will start with some welcome and introductions by Michael Collins, the faculty director of our center. Then we'll move into the presentation portion with a research presentation and then a discussant from ETF and from Empower Retirement. We will then have an audience Q&A with the speakers facilitated by Michael Collins, and then we'll sign off. I do want to remind all of our viewers today that we do have the ability for you to all be submitting questions throughout the presentation. In fact, we will pause for a moment following Anita's research presentation for some research related questions, clarifying questions, etc. So please feel free to submit your questions in the right-hand side of your screen at the in the question or chat box. And I also wanted to mention that today's session is being recorded. The link will be sent to all registrants of this workshop, and it will also be available on our website within 2 business days. And with that, I'm going to turn it over to Michael Collins.
Great, thank you, Hallie. Thanks to all of our panelists today. I'm going to actually let each of them introduce themselves as they go, but I just want to give everybody who's here today or listening on the recording a little background about why we thought this was such an important topic to talk about. These targeted research workshops are our attempt to take the research that we've conducted through the Social Security Retirement and Disability Research Center and to translate it into real world implications. What can be taken away from this research and from this evidence to influence how programs are designed, how policymakers behave, and in this case, how plan administrators approach some of the issues with their plans. This is one of the first of these targeted research workshops that we've conducted, and in part because we thought this was such an important topic. The idea of a defined contribution account has been with us for decades now, and we've now begun to see people approaching retirement and in retirement with these accounts. But we're also seeing what happens when you cycle through lots of different jobs, when you accumulate relatively small balances, maybe you forget about them or fail to roll them over. And so we have people who maybe aren't attentive to what they have in these different accounts. And then we have people who reach retirement and maybe have resources that could have helped them have a greater level of financial security, but weren't able to do that. So we're particularly concerned that these are people who are themselves financially vulnerable. And so for them, even if it's a few $1,000s, it might make a big difference. It's a complicated topic. You're going to hear some legal terms that are hard to pronounce and unusual, and so we're going to get into some of that. But I also think these are preventable problems, and so we can talk about some of the real-world solutions that can result in people actually growing accounts and maintaining accounts as opposed to maybe forgetting about accounts or losing track of accounts as they age. So with that, I thank you all for being here, and I want to turn it over to Anita to share her research with us. Thank you.
Great, well, thank you. So yes, as Michael said, I'm Anita Mukherjee. I'm an assistant professor in the Risk and Insurance Department at the School of Business here at Wisconsin-Madison. So let me just make sure that I can navigate these slides. I'm not able to forward just yet. But before I start the slides, I just want to also thank Michael, who saw this as a fledgling of an idea 2 years ago, and it's now become a serious set of research projects. So the feedback over the years has been extremely helpful. So today I'll talk to you about abandoned retirement accounts. This research has been generously supported by the Social Security Administration. And so none of this research is representing what that agency believes. So just in terms of background, defined contribution accounts, which are now the norm for most employees, require minimum withdrawals at age 70 and a half, right? And in practice, that's 72 years old. And otherwise, if you don't take these minimum withdrawals, the account is considered abandoned after some dormancy period. And it's usually about 3 years. And quite little is known about the prevalence of abandonment, right? Like, why would people save money that they eventually don't claim? It doesn't make any sense. Yet this is an issue that is of significant policy attention with, for example, the Retirement Savings Act of 2020 aimed at trying to make these old accounts easier to find. And so this project, quite broadly, is asking some basic questions in this space that hasn't really been studied empirically to date. So first, how many abandoned retirement accounts are there and how much is in them? What happens to abandoned accounts? And are there state policies that can help reunite people with their own retirement savings, this lost money? And finally, I wouldn't be here if we didn't find some abandoned accounts, right? So this is clearly a problem, as Michael mentioned. But why is it a problem? And so what does a survey indicate about some of the pain points in rolling over retirement funds and generally managing retirement accounts? So today I'll share with you a multi-pronged approach analysis that uses 3 kind of large and different data sets. The first is individual tax and information records on IRA holders. And so this is information that we've analyzed with co-authors at US Treasury in particular. Second is account level state unclaimed property data, which has been hand collected through Freedom of Information requests to various states. And third, a survey of retirement account holders, which has been collected by a survey through the employee trust funds, which Roger might expand on a bit as well. And so today's talk draws on 3 different papers. The main paper is this paper titled of the talk, Abandoned Retirement Savings, with Lucas Goodman at the US Treasury and Shanti Ramnath at the Chicago Fed. And it's also building on 2 previous works that were funded by the Social Security Administration with Karina Momeyerts, an assistant professor at University of Wisconsin in the economics department, on frictions in saving and claiming and lost and found claiming behavior in abandoned accounts. So just in terms of background, right, what happens to retirement accounts upon job separation? And why do I focus on job separation? Because our analysis suggests that this is the vulnerable point at which accounts kind of might diverge into on a path to becoming abandoned versus not. And so when you separate from jobs throughout your life, for defined benefit plans, which is in gray below, the funds simply remain with the plan and they reach out to you at the age that you're supposed to be getting the pension and they send you the check. For defined contribution plans, there is a difference based on whether the account is less than or greater than $5,000. So if it's a larger account, greater than $5,000, the funds remain with the plan unless the participant actively rolls it over. And for smaller accounts, when it's less than $1,000, you can cash it out with some fees or the money can go into a forced transfer account. And if it's between $1,000 and $5,000, the company has to set up what's called a forced transfer IRA for you. And so I'll touch more on these topics later, but basically this divergence of what happens with accounts at this point of job separation for DC plans is what ultimately gives rise to abandonment. So first, just as I think the broadest analysis we have is from these tax and information returns. So what do we learn from it? I think the key thing that we learn is that abandonment is prevalent. We estimate that 2.7% of 73, I'll say, year olds left $800 million on the table in 2017. And it's not all little accounts, right? So just below in this table, what I'm showing you is on the left 2 columns, the 2003-2006 patterns, and on the right 2 columns, 2014 to 17 patterns. But I want you to focus, for example, on the second row, which is the median, the 50th percentile of these accounts. We see that it was $9,000 in the early period, right? So it's not like a trivial amount of money. As a share of income, it's 24% of income in that retirement age that is being abandoned. And that amount is going down a little bit over time, right? So in the more recent years, we see that that median amount is $6,300 and 13% of income, but it's still substantial. And across the distribution, we see quite a lot of density in abandoned accounts, right? And in total, like I said, for 2017, this was $800 million cumulatively left abandoned. And just to clarify, what I mean by abandoned is people who have not taken the required minimum distributions for 3 years following the required age. Now, does the account always kind of stay abandoned? What we do see, we care obviously if people, okay, they may not claim for 3 years following the required minimum withdrawal, but they may act on it maybe a decade later. And so what this analysis is showing is that, yes, some people do end up finding these old accounts. Maybe they've still missed the required minimum withdrawals. They may have had to pay penalties on all that required minimum withdrawals that they missed. But what this is showing, and the x-axis is the account value. Now, it's not linear. So on the very left, you have just $30, then $100, then $300, and so forth. The one is $1,000. And on the y-axis, what you have is how many of these accounts were claimed within 10 years. And we see that it starts off at 30%, and then for accounts worth around $1,000 or more, it's roughly somewhere between 50 and 60% of them are reclaimed within 10 years. So what we see is that people lose track of these accounts, and about maybe 40% of them lose them forever, right? A majority of them do recover them, but still not at the optimal time that they should have. We also then analyzed abandonment among different types of accounts. And one policy movement that has happened in retirement plans that we think creates and may contribute to a lot of abandonment is default enrollment in retirement plans. And so what we did was we looked at this mini experiment with these forced transfer IRAs that I described earlier, where depending on your retirement savings, if you're between $1,000 and $5,000, the employer has to create this forced transfer IRA for you by default. And so what we see is that those accounts, the accounts that the employee, at job separation, the employer made it for them, they may not even know it's around, right? Because these are created by default enrollment. Those are much more likely to be abandoned than other types of IRA accounts. And so on the plots here, what I'm showing you is basically, let's look at the top left plot. It's showing that depending on whether the account value is less than or greater than $1,000, there is significantly less activity in things like changing your address for the accounts that are in these default plans, right? So the ever-changing their address is only 55% for the people in these default plans versus about 65 to 70% for people who are not in those default plans. And so we see that pattern across the different thresholds in terms of changing their address, which is an important part of staying engaged with your plan and might reduce abandonment later on, or in terms of any interaction with that retirement plan. So this full analysis is fleshed out in the paper, but I wanted to give you a sense of this mini experiment that we have showing that default enrollment may be a contributor to abandoned plans. So what happens to plans once they're abandoned? Some subset go to state unclaimed property. And so here I've just shown you the screenshots for Tennessee and Louisiana. Every single state has a website or some kind of a portal for unclaimed property. And what we see is that for retirement plans, we estimate that they send approximately $38 million to states. This particular estimate was from 2016, but it's mostly the small accounts. So what I've shown you on the x-axis here is the account value in 2012 dollars, and the y-axis is just the count of accounts that are sent to the state versus the ones that are sent to the state are in the darker color, and the ones that we see in the tax data are in the lighter color. And what we see is that a lot of the accounts that are sent to the state are the really small ones. Over a third of them are the accounts that were just less than $100, meaning probably that the plan did not find it valuable to hold on to these accounts and just wanted to get rid of them, so they eschewed to the state. But the high value accounts that you see in the light gray, the ones that are greater than 1,000, the ones that we see are in the median abandoned account, those tend to stay with plans. And the reason this is important, we think, is because it makes these accounts much harder to find, right? They're not sitting in state unclaimed property. It's one of our key policy vehicles to help reunite people with their own savings, but it's not getting the high value plans, and so or high value accounts. So as a result, the role of these state unclaimed property databases and in abandoned retirement accounts may be a little bit limited in terms of where it is right now. We do see some kind of rational behavior in the sense that within the state unclaimed property data, like in the tax data, higher balance accounts are more likely to be claimed. So, we don't have to go over the exact analysis here, but basically this increasing pattern shows you that as accounts become older and older, so as the account has been sitting with the state for longer and longer, the ones that kind of exit, that people go in and claim, On the y-axis, I'm showing you the log account value. Those tend to be the ones of higher account value, right? So people may be knowingly abandoning these tiny accounts, but they go in and do try to claim the ones that are worth claiming. One interesting experiment we have in the state unclaimed property data is very different methods of reuniting people with their money across states. So in particular, I'm showing Massachusetts and Wisconsin. In Massachusetts, over a 2-year period, so once a plan sends the account to the state, within 2 years, only 3.4% are reunited with the owner, versus 67% in Wisconsin. And so looking at this data, of course, we were wondering, well, why is that? And we learned that the Wisconsin model sends checks automatically to account holders if there is a social security number that can be linked. And so what I'm showing you in this plot on the x-axis is the way in which the account was reunited with the owner. Was it the Department of Revenue auto match? Was it a regular online process initiated by the account owner, or was it some other process? Probably the person came in person or made a phone call. And we see that that auto match particularly helps prevent the loss of these smaller balance accounts, which may or may not be super important. Like these tiny accounts, maybe people don't really care about them, but this vehicle is really important in terms of getting people their own money back. And so finally, why do accounts become abandoned? We did a survey with the Employee Trust Fund. And so this was, people of a different job tenure and savings choices. We had 3,000 plus respondents in their annual plan survey. And we just asked a couple of questions about, what did you do with previous savings? And, maybe to shed light on why do some of those end up being abandoned? And so we see that in one question, about 23% of people kept the account with the former employer. Another 4% don't remember. Now remember, these are state employees who I think are responding to the survey, so they're quite engaged. So this is going to be a population where we expect less abandonment. But still, what was the reason that you kept the account with the previous employer? A majority say it was just the easiest thing to do. A substantial portion, 14%, said, I don't know how to roll over funds. And another 9% said, I didn't know rollover was an option. So to us, this survey indicates that there is some learning, even among high literacy type populations, about how to manage and consolidate retirement savings as you port from job to job. And so just in conclusion, what we find, and I think what the stuff that we're most excited about with this research is that abandoned accounts are indeed prevalent. 2.7%, 3% of retirees have one. And the median value is actually close to 6,000. In an earlier subset, it was 5,000. And the total is $800 million. Even accounting for the reclaiming activity is still about $300 million each year remains permanently abandoned. Default enrollment appears to increase abandonment likelihood, and the policies on state unclaimed property may benefit from greater plan compliance, like plans just sending more accounts to states and more automated claiming. And if you're interested, the full paper offers some additional conceptual findings and additional analyses, because we do so much more with this data than I could cover here today, but I wanted to give you the best highlights. So I'll stop here, and thank you so much for letting me share this research with you.
Great, thank you, Anita. I want to just pause and see if there's any questions that people want to pose. The easiest way to do that is through the chat box, and we're going to have a larger discussion with the full panel in a minute, but I want to make sure people understand the basics of this research, and so clarifying questions right now would be perfect. So one question, Anita, is do you know how the plan sponsors try to contact people? Are they just sending out checks, or are they calling? What's sort of, when they do make an attempt to reach people, what are they doing?
Yes, I think the other panelists will have some insight on this Department of Labor guidance, but there's quite loose-ish guidance on this, right? So you're supposed to call people, obviously contact the last known address. At Wisconsin, where I have the most experience because I got to go visit many of these people, they do a lot of Google searches, right? And I know, Roger, you and I had talked about this as well, where there's just a lot of internet searches to try and find people. So it's not all mandated, but I think there's a lot of variance across plans and how much resources they have in doing this activity. And the federal guidance is that they have to send to the state at least accounts that are less than $1,000. And beyond that, they can keep them, and they're supposed to try and contact them through these different ways. But great. Yeah, I'll defer to my other panelists. I think they're more familiar being on the other side on what exactly is actually being done.
We can open that one up to the panel when we come back.
Yeah,
just one more clarifying question, and then we'll go on to to the next presentation. But I just want to clarify this, your analysis was really about IRAs, is that right? And sort of people as they approach that required minimum distribution that the IRS requires. Do you think that provides a good estimate, or do you think you're underestimating maybe what the scope of this problem is?
No, this is a great question, and one that I didn't highlight. So the tax analysis is limited to IRAs because of some constraints that we have and what we can see. But the state unclaimed property analysis includes all kinds of defined contribution accounts. And so we estimate that in the state unclaimed property, about half of those accounts are IRAs. And recent estimates are that the vast majority of retirement savings in employer plans are in IRAs. So we think that it's an underestimate, but also a pretty good, we think there's a fair bit of external validity to those findings to other types of defined contribution accounts. But that's a great question.
Great. All right, so anybody in the audience can feel free to type in a question in the chat at any time. But with that, I'm going to turn it over to Roger and have him talk about his view, particularly from the employee trust funds of the state of Wisconsin.
Well, thank you, Michael. Thank you very much. As was said earlier, my name is Roger Fletcher. I'm the director of the Member Services Bureau at the Department of Employee Trust Funds. And I'm looking forward to the chance to talk a little with you about forgotten retirement savings. I want to make sure that I can control the slides at this point, so we'll just do a quick check. Not quite yet.
Is that working now, Roger?
I'm trying. There we go. I think we've moved ahead.
There's a little lag on it, but it looks like maybe you have.
Okay. So I'll pick up from this point on, and I wanted to talk a little bit about the blue text on this slide. This is, one of the laws that governs the creation of the Wisconsin retirement system. And it's particularly pertinent today as we talk about really trying to protect people from the perils of old age and make sure that they can claim all the benefits that they're entitled to. And really, I'm grateful to be working for an organization where we put an emphasis on, making sure that people can access their benefits. So we do spend a good deal of effort trying to protect them from losing out on benefits they're entitled to. I'm going to give you a very quick overview of some information about the Wisconsin retirement system that I think is needed, so you'll have some context for the rest of our discussion. So I'll move ahead to the next slide here. As you can see from this content, Employee Trust Funds is one of the largest public pensions in the nation as well as the world, actually. The investing of the funds is done by the State of Wisconsin Investment Board, and they have an exceptional reputation for their long-term investment strategy. So between the system design and the top-tier investments that we have, we are consistently one of the top funded plans in the nation. We are almost always at 99 to 100% funded. We do have more than 1,500 employers, so we are covering employees throughout the state. These would be state employees, local employees, school districts, the university, the UW hospital and clinics, with the exception of the city and county of Milwaukee employees. They have their own retirement system. Today, I want to focus on the yellow graphic representing 173,000 people in our system who have stopped working. They have deferred benefits. These are the people who are most at risk of forgetting about their retirement benefits. You seem to have skipped an extra slide. In this slide, you can see the trust fund is designed so that the benefits that appear on the right side are pre-funded by the contributions from employees and employers, and mostly by the investment earnings In fact, investment earnings fund close to 80% of the benefits that are paid. As a hybrid defined benefit plan, the WRS contains elements of a 401k type of plan, or what you might think of as a defined contribution, but it also has elements of what you might think of as a defined benefit plan, or what some folks refer to as a formula type of calculation to arrive at a retirement benefit. Now, just what a member will actually receive is dependent on whether they are vested and whether they reach minimum retirement age before they take a benefit. I'll talk about that next. Employees, as you can see from this slide, who started since July 1 of 2011 must earn 5 years of service to be vested. Now, an important differentiating piece is that people who started prior to that, most of them, were immediately vested. They were automatically vested. This is not a thing that people often think of. It's unusual, but it's a key aspect. Now, being vested in the Wisconsin retirement system, of course, means that an employee is entitled to their contributions and interest, as well as the employer's matching contributions and interest. However, just because you're vested doesn't mean you get a retirement benefit right away. You must wait until minimum retirement age to take a benefit if you want both shares. And on this slide, you can see that minimum retirement age is 55 for most people and age 50 for our protective employees, such as police and firefighters. For people who are not vested, no matter their age, when they go to take a benefit, they're entitled to just their share and the matching, just their share and the associated interest. This is what we call a separation benefit. Some people think of that as a refund. So now that you have a little bit of background about our system, I'd like to share a little bit more information about lost accounts and abandoned accounts. There's an important difference for us between what constitutes a lost account or a lost contact versus an abandoned account. A lost contact happens when we receive returned mail that was undeliverable, and we mark the address as lost contact. Or we attempt to send mail and we use the national change of address through the US Post Office. We will also get feedback from that system saying that the address is no longer valid. Either case results in considering someone a lost contact. And you can see that from these statistics, 17% of the folks in that deferred benefits group have lost contact with us. That amounts to somewhere close to 30,000 people out of 173,000. That's quite a large number, and I'll talk more about why that's the case later. Now, if you direct your attention to the pie chart on the right-hand side, we refer to these as potential abandoned accounts, and I'm focused on just calendar year 2019 cases that we worked on. And these are a subset of the people with whom we've lost contact. Now, when we started the year looking for these people in 2019, we had 792 people on the list. And thanks to good people on my staff who use great tools, like Anita mentioned, Google. We also use some high-end investigative tools that are helpful. We found 85% of those people. 3% of the people had an account value below $429. Those accounts are automatically written off. We didn't look for those. 12% of the people had account values that were higher, but we couldn't locate them. And in those cases, what happens is that their names are published in the state newspaper, which happens to be the Wisconsin State Journal. And they're published on our website. And those folks have 10 years to come forward before their benefit is permanently written off. Now, writing off a benefit does not mean that the money goes to state lost property. With a trust fund, the money that has been put in the fund is really meant to fund those benefits. So when we write money off from lost accounts or abandoned accounts, that money goes back into the trust fund and is used to pay for future benefits. And now I'd like to highlight a few reasons why we see benefits going unclaimed. Forgive me. Our members are enrolled in the retirement system by default. So as Anita's research affirms, lots of members find our benefit less salient because of the automatic enrollment. Now, prior to 2011, another aspect that contributed to this was that employees' share of their contributions was paid by the employer as part of a bargained agreement. So the employer paid the employer's share and they paid the employee's share. Lots of folks would find that much more difficult to recognize that, oh yeah, there's something here that I need to act on. Since 2011, the contributions that each employee owes have to come directly from their paycheck. So we believe that in future, as we deal with lost accounts, that will help drive the number down a little bit. Certainly when contributions affect the bottom line, the account's going to be a little bit more salient. Now, as you can see from the callouts, there are some interesting reasons we hear from folks as we locate them and they explain why they lost contact with us. But really one of the most common is simply having returned mail. People move and they don't think to tell us that they've moved and we lose contact. Now, there are several more reasons that I'd like to cover briefly. The interest is granted in our system on an annual basis. So that means statements are only issued annually. When you're in touch with someone only once per year, there's a much greater risk of losing track. There are many reasons why we've lost track of so many folks as well. One of the biggest is that there's a big limit on resources, especially historically. There were severe limits on the amount of resources that could be spent looking for people who've lost contact with us. When the limits are that significant, it's tough to do even minimum compliance, much less looking for people earlier in the process. Historically, budgets have been limited so significantly as well that there were limited investments in technology, and that really causes a great deal of issues. With such tight budgets, we certainly don't have the systems where people can log in online and change an address or change a beneficiary designation. So those are significant barriers. Our experience reaching out to members also shows something interesting, which is that the majority of people we talk to, the majority of people who want to reach out to us, who want to stay in touch, they're within 5 years of retirement. So most people are age 50 or older, right? And a lot of the people who lose out on benefits are much younger than that when they've lost contact with us. However, we've taken a number of steps to help offset some of these unclaimed benefits and help members make this a little bit more salient. I'll talk about that next. So we have started, and I've moved ahead one slide too far, I believe. There we go, thank you. We've started a project to do targeted outreach, that's what we call it. And it means that we mail a series of letters to new employees. There's a year-long campaign where we mail some fairly simple information quarterly to introduce people to the retirement system. A good deal of it is trying to get them to take action, to get engaged in the benefits, and to make sure that they stay in touch with us. We recently updated our website as well, and the website is responsive design, so people can use it with smartphones. And we're certainly working very hard to simplify the language we're using and delivery of the content that we provide for members. Now, resources are still limited, very much so, but we are certainly trying to connect with members with whom we've lost contact much earlier in the process. The trail is certainly a little warmer if we can start much closer to the time when we first lost contact with someone. We're also partnering with Empowered Retirement, and through a fund to promote financial wellness, we are starting a program that will engage employees directly through their employer. And we're very hopeful that we will engage folks who are much newer to the system and some of our much younger members. We do have a multi-year modernization effort going on, and it will deliver such things as an online portal that we admire very much as tools certain third-party vendors provide, some of whom would be speaking a little bit later today, perhaps. Those wonderful tools will help people really engage with us. And we're also excited about the opportunity we've had to partner with the UW Center for Financial Security. We're learning a great deal from that partnership and applying those lessons every day. Moving ahead, I just want to point out that we have some, one page back for me. There are links here to information that could give you a little better background on the retirement system if you'd like to follow up at all. And we do have some wonderful webinars out there that could give you much greater background. And I'd like to thank you for the chance to share this information, and I look forward to taking any questions people might have.
Great, thanks, Roger. And Anita, great research. Roger, really appreciate the perspective from the public side of things. My name is Rob Dyer. I'm the Vice President of Government Markets here at Empower Retirement. And I am fortunate to, as I slowly gain access to the slides. I was asked to come in and provide a little bit of perspective from the private sector, from a defined contribution retirement services provider. What is our experience with unclassified checks and unclaimed property? And I'm just waiting for these to advance real quick.
Is it working for you yet?
Not yet.
Quite the delay, eh?
Yeah. That's right. I've got a soft copy here in front of me. So I'll go ahead and get started. So the topics I wanted to cover from Empower's perspective is really what causes the problem with unclaimed property as a defined contribution plan rec keeper. What's the scope of it from our side of things? What are some things that Empower are doing to address this need? That includes some state achievement experiences that Anita had pointed out, and then ultimately, what are we doing to make it easier for clients or customers to stay engaged with us, so that they're constantly reminded that they got this important retirement benefit here at their fingertips. And why that's thinking about advancing. So for those of you that are not familiar with Empower Retirement, we are the second largest rec keeper in the United States, providing defined contribution plan rec keeping. Thank you. To public and private sector employers that are out there. So we've got about 12.2 million Americans that we're fortunate to be servicing, and about $834 billion in assets under administration. So those numbers are really important for this particular topic, because as you can surmise, we cut a lot of checks on behalf of our customers that request them. We're fortunate to have a lot of business in the state of Wisconsin, but our largest client, and we're very fortunate to be a partner with the state of Wisconsin Deferred Compensation Plan. So our footprint with that partner is $6.4 billion. 66,000 Wisconsins, probably a little bit of snowbirds mixed in there, living in Florida, Arizona, and 952 local governments are participating in the WDC. So a lot of engagement with state and local government there in the state of Wisconsin. So what's causing the disconnect? And a lot of this really aligns with some of what Anita's findings were on the IRA side. But the vast majority of our unclaimed property is almost exclusively related to when a participant doesn't request or didn't consent to a distribution. And let me tell you what I mean by that. So you have de minimis requirements in a plan document that governs the retirement plan that the state, the WDC as an example, Wisconsin Deferred Comp Plan has to manage, right? So we've got, let's say, a de minimis provision in there, meaning that anybody that hasn't contributed in 2 years and their account balance is less than $1,000, they will instruct us to liquidate that account and pay it out to the address of record. The participant didn't ask for it, they didn't consent to it. The plan sponsor is just exercising their fiduciary duty to adhere to the plan rules through the plan document. Another way is IRS, making sure that our participants are meeting the required minimum distributions and they're not being penalized via taxes. So we initiate that process with our plan sponsors as well. And then lastly, for this category of non-consent, not requested, you've got some plan designs, plan documents that suggest that the benefits need to be distributed at normal retirement age. So those are kind of the three areas that we see where people are not requesting this information or these payments. And then kind of the last category is what we call kind of trailing funds. So let's say the participant or the customer, they liquidate the account, they move on, they change their address, they don't notify us because the account's closed. We lose connection with them, but let's say a trailing contribution from the employer comes in, or there's a correction that has to post to the account. When we lose connection in those circumstances, and often the account balances are very small, that definitely leads to the unclaimed property cash that we have on hand. So a little bit of the scope of the problem at Empower. So in 2018, we had about 3.5 million distribution checks that were processed, and 15% of those kind of fit into that unrequested bucket. So you're talking about 525,000 people we cut checks to that were not expecting it, or they didn't request it at least. And 5% of all the distributions of that 3.5 million were returned due to the incorrect address or they just didn't cash it. We find that a lot of folks, because the amount is so de minimis, it behooves them to say, it's not enough, it's not worth the pain to go to the bank and get it cashed. The average amount that we're finding in terms of the return checks, as you can see here, is $348. Almost half of those uncashed checks represent less than $25, can go into the mindset of the behavior that participants, if the dollar amount is so nominal, why go through the hassle? And a little bit of comparative data, the Spark Institute, which is the Society for Professional Asset Managers and Record Keepers, so this represents the largest record keepers in the country. They reported the DOL that 78% of the uncashed checks as an industry was less than $100. So what's doing to manage this process when we do receive notification that the person no longer lives at that address? So when we get return checks or return mail, we'll automatically put a mail hold on that account. And if the return mail has the yellow sticker that you might, for some of you in the operations might recognize that has a forwarding address on it, we will update the account of record with that address update that's provided by the post office. We also do quarterly credit checks and searches through our third-party vendors, because we think that if people are applying for credit, which all of us do periodically from time to time, we'll get that updated address information there. We'll also do next of kin searches, and then one of the things that we will do to make sure the people that we're sending money to are still alive, we'll periodically do death certificate searches to make sure that the payment that's going out is truly to the person that's still with us, and if they're not, we are prompted to put a hold on the account until further notice. The other process is the state achievement process, which Anita had spoken to. So just for some perspective, I've footnoted the time period here, but we process about 150,000 uncashed checks totaling $31 million. About 40% of those, as you can see, were less than $5. Again, if we can't find the person or the person gets the check, it's not worth the hassle of them to go into the bank and get it checked or get it cashed. There are some state achievement laws that require us to send out notifications. And so in this instance, we sent out 26% hit the threshold where we need to send out notifications, and we're able to pay out about 20%, 26% of the participants that were on our list to find a home for that money. And as Anita had alluded to, that really tied to the folks that had a higher account balance with us, that they claimed about 44% of the total assets. So in total with the states, we only really sheeted in that time period probably just shy of $18 million from Empower's record keeping platform. And then lastly, what are we doing up front to make sure that we're staying connected with our customers? So, one of the best practices that we really emphasize with the plan sponsors and employers is we need a really strong data relationship. And what I mean by that is, are we getting, when employees enroll or when employees are hired on, we can get a data feed of those eligible employees and include their cell phone numbers, their personal email address if it's provided, obviously their home address. But that really helps us do a bunch of different things. It helps us with fraud mitigation. It helps us stay connected to participants when they're no longer employed with that employer. And it really also helps us drive more personalized communications to that individual to help them with retirement decisions. From a call center standpoint, 100% of the calls that we receive, we always ask to confirm the address that the one we have on file is going to be accurate. And if it's not accurate, we'll certainly provide some, we'll update it once we authenticate that person over the phone. Allowing for online beneficiary capabilities is really key. You got to make it easy for folks to engage and keep their personal information up to date, and beneficiaries is a big part of that, right? And so allowing mobile and web capabilities to allow folks to engage digitally with Empower to kind of maintain their financial retirement household. And then we also are really encouraging retirees to do ACH payments versus checks. As folks move, they'll change their address, or they won't change their address, but they likely won't change the bank. And so we feel like that's a good mitigation technique to do that. And then in regards to checks for snowbirds, so what we learned through our experience is that when folks were saying, hey, I want to keep my address record the same in Wisconsin, but I'm going to be out in Florida for the next 6 months for the winter, can you just send my payment down there? What we're finding when we're allowing that is that they had moved there permanently. They never update their address of record, so we only make distributions to the address of record going forward for us. And then lastly, with mobile capabilities, as I said, we know that 98% of U.S. adults have access to a smartphone. We know that we all spend on average 3 hours plus, attached to that device. And so you got to meet people where they're at. And so we continue to invest heavily in our mobile capabilities and technology to make it easy for people to engage with us. So this is a really important topic, and I applaud you and the team for doing the research. It's certainly passionate to Empower as we continue to lobby Washington, D.C. on trying to make improvements on behalf of our plan sponsors and fiduciaries. So with that, I think we'll kick it to Michael for some Q&A session.
Great, thank you both Rob and Roger for your take on some of these key issues. And now I want to encourage our whole panel to come back and go online, and we can do some Q&A. And again, I encourage audience members to go ahead and type in any questions that you might have for the whole panel or for individual panelists. Just let us know, and we can certainly entertain those. But I have one question that I want to just throw out there in the first place. And from each of your perspectives, do you feel like this is a problem that's getting better or getting worse? We're seeing, the first generation maybe of people who've had these defined contribution accounts. Maybe we're getting better technology, better tracking. Is this going to start to decline over time, or do you think this is something that's going to continue to be with us for a while?
Yeah,
I can offer. Oh, go ahead.
This is Rob. I'll go first. I think as we continue as a society, continue to gravitate towards technology. Anita did a lot of her research on the IRA defined contribution space. There's a lot of record keepers out there that are looking to make that process much easier, because historically it's been a pretty complicated process for people to fill out all the documents, follow up with the provider, see if the check has been sent. So I think as an industry, we're getting better to make it easier for the customer when they make that financial decision to move money as they need to. But also I think the technology investment, like I said in mobile in my closing remarks, I think that's just going to continue to hopefully improve the situation. I know that as an industry, we continue to lobby Washington, D.C. to on behalf of our clients, the fiduciaries, to make improvements in this area. And so I see it, the short answer is I see it getting better over time.
Yeah, and I was going to offer, I also sort of personally agree that it's likely to get better because of many of the technological advances. But I do want to highlight that in the data, we see a quite increasing pattern of abandonment over 2003 to 2017. And it could be, Michael, because of what you said, right? People are kind of transitioning into DC accounts, maybe don't quite know how to consolidate and manage them. But interestingly, we see that the balances are getting smaller that are abandoned, but the number is getting higher. And so it may be that, you know, people are moving around jobs more and so are having more of their savings accumulate in these little accounts that are harder to manage. But that's something we don't have strong evidence on yet, but I think raises a big question.
Yeah, I could support both of our panelists' comments so far. And I think in the case of employee trust funds, we really need to take some leaps in terms of technology. So we'll see some advancement as a result of that in particular. But from a global standpoint, I do worry that as generations come up, you know, this type of benefit could be less salient. People are expected to move around through jobs even more than they are now. So combining those things, yeah, I would anticipate that overall more accounts will be abandoned, and you know there is some need for the suggestion that you know Anita has raised, that there be some sort of clearinghouse where all of these types of accounts are reported, or people can locate their benefits.
Mm-hmm. So Anita raised this issue of the Wisconsin model, if we want to put quotes around this, the Wisconsin approach of, you know, trying to locate people through Department of Revenue records and others seems to be pretty successful. Why is this unique to Wisconsin? Why aren't we seeing this more broadly? Should this be a standard practice that we see across states?
Yes, I'm happy to shed some light on that. So I've had some really great conversations with Erin Egan, who directs the unclaimed property here at Wisconsin. And so she said it's now called the Wisconsin model because 5 other states have copied this method. I mean, basically, it's just using Social Security numbers to send checks. But I think one of the main kind of reasons that Wisconsin and only 6 states in total do it out of the 50 is because at Wisconsin, it's housed within the Department of Revenue, this division of unclaimed property, whereas in most states, it's housed within the Department of Treasury. So I think being in the Revenue Department, they just already have access to Social Security numbers, which makes it easy to do this match. But I don't have a great sense if that's the only constraint, and that's something that I think at least Erin mentioned that is a huge topic within the National Association of Unclaimed Property Managers, like trying to automate processes. And it doesn't seem very expensive, so I'm sort of optimistic that it can be scaled to other states.
I know from our experience, we do, when we force a distribution, as we call it, we will match against a Social Security number as well. We will make sure that you know we have the right person before we force a payment. But our experience shows that that can be challenging. There are times where the match may not turn out the way you think, so you have to be careful.
Yeah.
And I do believe you know Department of Revenue has it down to a science. They are exceptional, but we use some other third-party tools that help, but it still leaves some question about matching to the right person.
So a question from the audience for Roger. Do you have an estimate of how long it takes or how much it costs to locate these abandoned account owners?
Oh boy, that is a great question, and I don't really have a good estimate of you know how long it takes or how much we really invest in that. We're really trying to you know do our duty to get the money back to these members. So you know we focus on doing as much as we can within the time that we have available to us. And you know every day is a balancing act in terms of resources. There are 4 supervisors who report to me who juggle all of the resources every day, and it's a constant thing going on. So some days we don't have time to work on this. We don't get to it at all. But other days, you know, if workload is well under control, we can spend a little more time and effort.
Great. And another question, I'll open this up to everybody, but I think Rob mentioned it, so I'll let you take first crack at it. So there is this relatively new Department of Labor guidance, which really highlights best practices for managing abandoned accounts. Do you think that's going to change the way that plans are administered? Do you see that as sort of a step along a longer set of rules that maybe we're seeing down the line? Sort of what's your crystal ball there?
Yeah, I think it's a step in the right direction for sure, right? Anytime that we can provide some best practices for industry or plan sponsors to follow, and hopefully drive some consistency, across, this issue would be, really important. One of my peers had testified to one of the advisory councils that reports up to the DOL on this very issue back in 2019, really asking for this on behalf of our plan sponsors and the fiduciaries to help make it easier, clear roadmap. And that the pension legislation or the best practices that were just published, I think it was January 12th of this year, we're still evaluating those. We've read through them. We feel like we checked the box on most all of it, but there are some new things in there that we're evaluating right now. And so we're still kind of determining, what of those best practices we're going to be able to implement.
Great. Other thoughts on the Department of Labor guidance? All right, so we'll wait and see. So let me go back to a question that came up with when we talked the clarifying questions with Anita. How is it that plan sponsors are trying to reach out to people? And specifically, how are they trying to reach out to maybe somebody who's older, or maybe even the kin of somebody who's deceased? What are the processes that they go through?
So, what I know is a lot from having talked to Roger prior, right? Where I think you had mentioned that there are these internet searches and phone calls and, just kind of lots of effort to try and locate the person. And I think from everything that I've read, and, certainly Rob knows more, I'm sure too, but it's just, it seems like a lot of cohesive efforts and a lot of creative effort. And that's maybe why it's hard to capture the cost, because it is so much based on, how much time and resources available to try and contact people. The official guidance doesn't seem, and you can correct me, it doesn't seem to be very strong in terms of what you have to do, right? It seems that you have to at least mail to the last known address at least twice, but then beyond that, how you reach out to these abandoned account holders doesn't seem very explicit.
So in our case, if I could jump in, the minimum compliance is a minimum, really. There is not much we would have to do, and we could simply pass these accounts back as written off, and if people come forward, they come forward. We have to look in our records to see if we can find a valid address. We have to use some sort of tool, like an online tool, to try and locate them. And we have to make a number of attempts at a contact. That's due diligence. Once we've done our due diligence, we could be done. But we would like to get these benefits back to these people. And we know that with a little additional effort, at least, there are much better tools out there. One of the tools we use is an investigative suite through Thomson Reuters called Clear, and you have to be a government agency in this case to get access to it. But this tool allows us to, make sure that we have the right person, essentially. It gives us a history of people who lived nearby, people who lived in the address that was there, all kinds of great information. But as you can see from all of that, it's a process. It's an investigative effort to locate people. It's a lot of problem solving. So that's a little bit on our approach.
Mm-hmm.
So Michael, I have a question for Rob and Roger, but I don't know what the audience has, or should I go ahead and ask mine? Okay. So one thing I was really surprised by, so Michael has seen me present early versions of this where I said, this is really important because people face really high penalties if they fail to make their RMDs. It's like 50% of what you should have taken out. Now, in the newer versions of my presentation, I don't motivate it with that anymore, because what we see in the tax data is that very few people actually pay that penalty. And so I'm just curious from your perspective, is that something that motivates these, like Rob in particular, you said the unrequested distributions that are sent out. Like, what is the reasoning? And do you think people could be kind of intentionally not complying with the RMD because there maybe are no penalties, and maybe it's just a tax advantage to claim it later? I'm just curious. I don't know.
Yeah, Anita, unfortunately, I don't have a deep perspective into behavior and the thinking behind that. I'd be happy to get back to you on.
Or at least, what's the motivation for the unrequested distributions? Is that something legally you have to do? Just
yeah, so it's more of a customer service approach, right? We work with our plan sponsors. We say, hey, here's the people that are going to hit it, and then we work with them to provide direction to us to say, yep, let's go ahead and make sure these people don't get penalized, and we work with them to do the distributions.
Got it.
Yeah, indeed, part of the purpose there is to distribute that money, and that of course generates tax dollars that go to the federal government, right, and state governments for that matter. But that's one part of it, and certainly we have a lot of experience talking to people as they're approaching that age, because we actually start our process reaching out to these people in their 60s, right? And as we're contacting a lot of those folks saying, hey, you have this money and it's going to be time to take this pretty soon, they are saying, I don't want to. I wanted to hang on to it. I wanted to leave it there. Can't I leave it longer? Can I put it somewhere else where it could grow? We do have a lot of experience hearing that from people. So moving the age from 7.5 to 72 was a good thing in that sense, but yeah.
That's great.
Well, we're just about out of time, so I want to thank you all for your questions in the audience. We have a few more unanswered questions, and maybe we'll try to find a way to get those posted. But thank you to the panel for taking this on. I'm going to hand it back to Hallie.
Excellent. Thank you so much, Michael, for your facilitation of today's event. Thank you, Rob, Dyer. Thank you, Anita Mukherjee, and thank you, Roger Fletcher. It's been an excellent event. And like Michael said, there were plenty of questions that came in and a few that didn't get answered, but we do have those recorded. And I can provide those to our panelists following this call. And I did want to let everybody know, just reiterating that this was recorded today. You will receive a copy of that recording in your inbox tomorrow. I will also post the slides as well as links to Anita's reports and her research briefs on this topic alongside that recording on our website. So please do look for that. And with that, I'd just like to thank everybody who attended today and wish you a good day.
Thank you.
Thank you very much.
Thanks, everyone.
It's a pleasure.